studying your last two. I swim with tea when they turned in. The staring down to mute and can learn the pole that sunk he died.
Before helping a client decide between salary and dividends, one of the most important steps is understanding their current CPP status. Many owner-managers focus immediately on tax savings, but compensation planning involves more than just current year taxes. It can also affect future Canada pension plan benefits and long-term retirement planning. At the center of the slide, we see an owner-manager facing a common compensation decision. Should income be taken as salary or as dividends? The salary path is shown on the left. When compensation is paid as salary, it generally creates pensionable earnings. Those earnings can generate CPP contributions, and those contributions may help build future CPP retirement benefits. As a result, salary compensation is often connected to the accumulation of future pension entitlements. The dividend path is shown on the right. Dividends are treated differently. Dividend income does not generally create CPP contributions, which means no additional CPP benefits are accumulated from those dividend payments. While dividends may offer advantages in certain situations, they do not normally increase future CPP entitlements. This is why understanding a client's CPP status is so important before making compensation decisions. Several important questions should be considered. Is the client currently contributing to CPP? Have they already reached the annual CPP contribution maximum? How much CPP contribution history have they accumulated over their working career? Will the compensation strategy chosen for the current year significantly affect future CPP benefits? The answers to these questions can influence whether salary, dividend, or a combination of both may be appropriate. For some clients, maximizing current cash flow may be the primary objective. For others, building long-term retirement benefits through CPP contributions may be an important part of their overall financial plan. The key point is that compensation decisions should not be made in isolation. CPP considerations are part of the broader planning process. By understanding a client's current CPP position, advisors can provide more informed guidance and help clients understand the trade-offs associated with different compensation strategies. The key takeaway from this slide is that CPP status matters. Before choosing between salary and dividends, owner-managers should understand their current CPP position, because today's compensation decisions can influence both current cash flow and future retirement benefits. Once we understand why CPP status matters, the next step is learning how to determine a client's current CPP position. Good compensation planning starts with accurate information. Before recommending salary, dividends, or a combination of both, it is important to understand the client's actual contribution history and current CPP situation. The process begins by gathering income information. This includes reviewing documents such as T4 slips, payroll records, and personal tax returns. These records help establish the amount of employment income earned and provide a starting point for understanding CPP contributions. The next step is reviewing CPP contribution history. Contribution records show how much has been paid into the Canada pension plan over time and whether the client has been making regular contributions. This information can also help identify whether annual contribution maximums have been reached in prior years. After reviewing contribution history, government records should be examined. These records provide valuable information about CPP participation and estimated retirement benefits. They can help verify contribution history and provide a more complete picture of the client's future CPP entitlement. The next step is reviewing the current year's compensation structure. This is where salary and dividends begin to play an important role. By examining how compensation is currently being received, advisors can estimate how future CPP contributions may be affected. For example, if compensation is primarily salary, CPP contributions may continue to accumulate. If compensation is primarily dividends, additional CPP contributions may not be generated. Once the current compensation structure has been reviewed, the final step is assessing future CPP impact. This involves projecting how compensation choices may influence future retirement benefits and evaluating whether the client's long-term retirement objectives are being supported. Notice the role of the advisor shown on the right side of the slide. Reviewing CPP information is often most effective when done as part of a broader compensation planning discussion. The objective is not simply to determine current contributions, but to understand how future decisions may affect retirement income. Several sources of information can help with this review process. These include T4 slips, payroll records, tax returns, CPP contribution statements, pension records, and government account information. Each source contributes a piece of the overall picture. The key takeaway from this slide is that compensation decisions should be based on facts rather than assumptions. Before recommending salary or dividends, it is important to review contribution history, current records, and future retirement projections. Accurate CPP information creates a stronger foundation for effective planning and better long-term decision-making. Now that we know how to determine a client's current CPP status, the final step is understanding how that information can be used in compensation planning. For many owner-managers, the choice between salary and dividends is not simply a tax decision. It is also a retirement planning decision. The compensation strategy selected today can influence both current cash flow and future pension benefits. At the center of the slide is compensation planning. Notice that CPP considerations are only one part of a larger planning process. Other factors include retirement benefits, current cash flow needs, corporate tax planning, personal tax planning, and long-term retirement goals. All of these elements should be considered together rather than in isolation. Let's first look at the salary strategy shown on the left side of the slide. When compensation is paid as salary, CPP contributions generally continue. Those contributions create additional pensionable earnings and may increase future CPP retirement benefits. Over time, ongoing contributions can help build a larger CPP entitlement that may support retirement income later in life. For some owner-managers, this future pension benefit is an important part of their long-term financial strategy. Now, let's compare that with the dividend strategy shown on the right side. When compensation is paid as dividends, CPP contributions are generally not generated. Because no additional CPP contributions are made, there is normally no increase in CPP pension accrual related to those dividend payments. However, dividends may provide other planning advantages depending on the circumstances. For example, more cash may remain available within the corporation or be distributed without creating additional CPP contribution obligations. This is why neither approach is automatically right or wrong. The best choice often depends on the owner's priorities. Some individuals place significant value on building future CPP benefits. Others may focus more heavily on current cash flow, corporate flexibility, or other tax planning objectives. The comparison shown at the bottom of the slide highlights the core trade-off. Salary generally leads to continued CPP contributions and potential future pension growth. Dividends generally do not create additional CPP contributions and therefore do not increase CPP pension accrual. That is why professional planning is so important. Reviewing CPP status annually, coordinating compensation planning with retirement objectives, and understanding the long-term impact of compensation decisions can help owner-managers make more informed choices. The key takeaway from this slide is that compensation decisions affect more than just taxes. They influence both today's cash flow and tomorrow's retirement benefits. By understanding how salary and dividends interact with CPP, owner-managers can make compensation decisions that align with both their short-term needs and their long-term financial goals.